Welcome everyone to Riveron's Ask the Experts webinar. We will allow participants another minute to come online. We'll be back shortly. Hello everyone, my name is Michael Cahill, and today our Ask the Experts webinar will focus on special purpose acquisition companies. SPACs are back. We hope that you and your families are safely navigating our current environment and doing well. There's been an uptick in SPAC IPOs and mergers this year, and today our experts will touch on the trends they are seeing in the market and with current projects. We're very excited to share the SPAC content with you today. However, before we get into the content, let us spend just a moment on some key reminders. All of Riveron's webinars and replays may be obtained at our website, riveron.com. Please visit that for more information and other thought leadership pieces that the firm shares. To obtain CPE for today's session, you will need to respond to 4 polling questions that we will weave throughout the webinar conversation. If you have any questions or issues that arise during the webinar, please use the Zoom Q&A function. You'll be able to ask your questions. We'll monitor those questions and respond time permitting at the end to any questions on the content today. If we don't have time to respond within the webinar, we will follow up with you after the webinar. Webinar evaluation forms and CPE certificates will be emailed to you. They will come in about a week to 10 days into your inbox. With that, you will also obtain a copy of the webinar recording that you can replay, a copy of the deck, and the ability to sign up for future webinar mailings for future webinars. The presenter contact information will also be in that message. And if anyone is interested, we will share a SPAC IPO playbook. All you have to do is just reach out if you're interested and contact one of the presenters. Today, I'm joined by 4 of my colleagues who will present on the material. They are Greg Carlson, a managing director from our Houston office. Greg focuses on integrations and operational transformations, technology optimization, and capital markets projects. Ryan Gamble is a managing director out of our Chicago office and leads Riveron's tax practice firm-wide. Zach McGinnis is a managing director out of our Houston office and heads Riveron's SPAC practice, frequently presenting on SPAC topics and has been published in numerous thought leadership pieces. Finally, Josh Motter is a senior manager in our Houston office within our financial advisory practice, focusing on capital markets with an emphasis on pro formas. To begin, we will start with our first polling question. Is your organization planning a SPAC IPO or merger in the future? Yes, in 0 to 6 months. Yes, 6 months or longer. No, uncertain, or what is a SPAC? Please take a moment, read the question, and answer for CPE purposes. While we're waiting, Zach, can you share a little bit of, I mentioned earlier that the uptick in SPACs this year. What do you see as a couple of the key drivers for that increase in activity?
Yeah, thanks, Michael. Welcome everyone. Thanks for joining the webinar today. A couple of points on this is, given our, uncertain economic world that we're living in, SPACs are viewed by some as a safe haven, where capital can be parked in a trust account with a sponsor management team with credibility to be part of a deal that they may not otherwise have a chance to be a part of. Second is probably investment banking fatigue. The SPAC vehicle provides an opportunity or an alternative to access the capital markets outside of the traditional forms. So we'll go into a little bit more detail about the different models in a second, and just general acceptance. It seems that accounting firms and law firms are starting to accept this vehicle a little bit more, whereas back in the day, dormant, wound down shell companies were the option, and now these active SPAC companies are born for purposes of a strategic acquisition. So, probably 2 or 3 things that release the conversations we've been having with our clients as to, why SPACs and why now.
Thanks, Zach. Yeah, the results are in, and really there's, a variety, with probably the majority not, moving to a SPAC in the near term. But I think now, Zach, if you can just cover in a little bit more depth some of those trends that you touched on there.
That sounds great. So the next few slides, we'll go through just some high-level trends, a little bit of data, and a comparison of the traditional IPO path versus the SPAC path. So we go to the SPAC trend slide here. So the data here has been provided by our friends and colleagues at SPAC Research. As you can see, from 16 to 20, the gross proceeds raised by SPACs, the average deal size, in this case, capital held in a trust account by the SPAC before the legal acquisition occurs, has seen an uptick, and obviously the number of IPOs, SPAC IPOs before the de-SPAC process has seen a pretty interesting uptick. A few stats here: 40% of the total IPO volume in 2020 is attributable to a SPAC. 33% of IPO proceeds are attributable to SPACs, which is obviously up from the prior years. So, a couple points on kind of why that may be. SPACs have kind of reached a celebrity status, if you will. So ex-speaker Paul Ryan has announced that he's going to be part of a SPAC sponsor team. Even Ashton Kutcher has announced that he may be part of one as well. So all jokes aside, SPACs have reached that point of probably celebrity status, not only from a trends perspective, but from a sponsorship perspective. It's hard to watch CNBC for more than a couple minutes without SPACs being mentioned. There are clearly some industries here that are more actively involved in this space than others. Electronic vehicles, some sports and gaming companies, tech and healthcare obviously are areas that are active in the IPO space and the SPAC space. For us, what's going to be really interesting over the next year or two is the tsunami of de-SPAC events, right? So the SPAC goes public first, and then within 18 or 24 months, there's a de-SPAC event where the SPAC legally acquires the private operating company, and then that private operating company becomes the publicly traded SEC registrant. So what will be fun is the tsunami of de-SPAC events that are going to be coming down the pipeline here in the next year or two after the SPAC IPO process. We go to the next slide here. So this is just a quick depiction of the overall process. A couple of interesting points here for folks that are familiar with the traditional IPO space is the timing that we mentioned. In the SPAC IPO before the de-SPAC, usually we see the SEC get through their reviews a little bit quicker than a traditional operating company, revenue generating non-blank check operating company. And so the usual path is about 75 to 90 days for a traditional operating company to get through SEC review versus a SPAC IPO is much shorter, sometimes even weeks or a month or two. Another interesting part here is on the target search, the blue middle section. We're seeing a trend in sponsors attacking these deals and shopping for opcos earlier. Back in the day, again, 2 or 3 years ago, SPAC sponsors would wait until their IPO went effective and then started the shopping process for an opco reverse merger, de-SPAC, if you will. And now we're seeing probably those sponsors start the diligence process and the shopping process even before the SPAC IPO goes effective, so that they don't put that market timing window at risk, which in some cases we've seen in practice an extension of that timeline to get the deal done. Okay, go to the next slide. What we wanted to do just quickly is to show kind of an infographic of what we see in practice as the key differences in an IPO and a SPAC. On the cost side at the bottom, not to start from the bottom and go up, but on the cost side, the sponsor is going to have traditionally a 20% promote as a replacement from folks on the phone that are familiar with traditional IPOs, around a 6% or anywhere from 5 to 7% underwriter discount. So the sponsor obviously has an interesting position in these deals. On the marketing side, for folks that are familiar with a traditional IPO, there's a 2-week roadshow at the back end of the process, and call it, non-price transparency, versus a SPAC that may have a little bit more price transparency in the front end, since the deal terms are set in the LOI and the merger agreement. So less of a surprise. But on the marketing side, instead of a roadshow, there's a 20-day shareholder vote, typically between the point at which the SEC declares the proxy or the S4 effective and when the deal actually closes. So a little bit different marketing. And then the timing we talked about, the SPACs have a SPAC clock. We've had clients that have done IPOs that took several years because of external market factors or other deals that happened in the process that, in an S1 traditional IPO, you have a little bit more flexibility in the timing, versus a SPAC. There's a pretty defined period of time in which that has to close. So some pressure there that causes some complications from an organizational and financial reporting perspective that we'll get into. Okay, at this point, I'll hand it over to my colleague, Josh Motter, Senior Manager in our capital markets practice, to talk about some of the financial reporting aspects in a SPAC IPO and then SPAC merger.
Great, thanks, Zach. Over the next couple of slides, we'll walk through the SPAC formation IPO process through the S1, as well as the de-SPAC process through generally an S4 or a proxy 14A filing, and then ultimately talk a little bit about some of the accounting implications in between there, as well as some of the things to think through as the operating company continues forward as a publicly traded registrant. So starting with the formation of a SPAC, a little bit different than a normal operating company in that there is no real operations, and there is pretty much just a management team as well as the sponsors. And those sponsors and management team collectively form an asset that is going to market to attract institutional investors as well as other investors into the experience that team has in forming these IPOs and working through and generating value. So with that, the sponsors generally are going to provide the initial seed funding in order to finance operations through the merger date with an operating company. And that's going to include things such as accounting, legal costs, and other standard operating costs as you continue through the S1 filing. As you start, you understand that there's a little bit of complexity when dealing with the units. So different from a normal IPO, you have units which represent a single share as well as a combination of warrants. Those warrants can range from one warrant equal to a single share, or it can be half or a third of a warrant typically. And what that means is the institutional investors and other investors into the SPAC actually have an opportunity to generate increased value that goes beyond a single share, given the share price of the future registrant reaches certain thresholds, generally $11.50 per share. So moving forward, you've got your IPO process, which is actually pretty similar to that of a traditional IPO S1 filing. I will point out, if you look down towards the bottom of our slide, we've got an SEC review period, which generally is about 6 weeks. You'll notice that's much shorter than a typical IPO. And the reason for that is there's no operations of this SPAC, and it's really just financing held within a trust account. So very little that the SEC actually has to review, and generally pretty boilerplate. So that process is pretty quick. So understanding that from initial S1 to S1A amendment filings, depending on your interim periods, you might have to update for the most recent ended interim periods. Pretty standard again for these SPACs is there really isn't a ton of activity that's going through there. So interesting to note as well with the post-IPO, a SPAC, just like any other publicly traded company, will be required to comply with their standard interim and annual reportings under 10Q and 10K, and will also be required from a CEO and CFO standpoint to sign the 302 and 906 certifications, effectively presenting to the public that their controls are effective over financial reporting. So after that, you get to really the most exciting time, which is the merger and financial reporting of the operating company. So why is this exciting? Well, everybody's getting paid at this point, right? So you merge an operating company with the SPAC, and with that, there's a lot of regulations and forms that get filed with the SEC, as well as a lot of challenging accounting that needs to be considered. So the first is, as a public company versus a private company, you likely have a lot of tax implications as part of this enacted merger that you need to think through, both from a C Corp structuring as well as your what's called a steps plan, in effect, how the merger is going to be consummated. So Ryan Gamble will talk about that in a little bit here. So we'll continue through some of the more technical accounting aspects, some of which are going to include drafting interim financial statements. Generally speaking, as an operating company, you don't draft interim financial statements. So drafting a full set of interim statements can be challenging, and those will also require auditor review as part of this initial S4 filing. Annual financial statements also required to be SX compliant with the SEC and will require PCAOB level audit procedures. This can be quite a challenge when or a surprise in some circumstances where you've had historical financial statements audited, so you think that everything's ready to go, but the step-up procedures that are required for your auditors to get through, as well as some of the incremental review by national practice for these SPACs, can result in additional audit requests, as well as certain adjustments that wouldn't have been caught under an AICPA audit. So can be a significant lift there, depending on the complexity of some of your audit. In addition to that, management's discussion and analysis will be required, as well as other sections of a public filing, such as risk factors and business section. Another complicated factor of an S4 filing in these SPACs as part of the reverse merger is Article 11 pro forma financial statements. Can be a pretty significant lift. So in lieu of going through all the details of these statements, it in effect considers the merger of the SPAC and the operating company as if the transaction had closed at the beginning of the preceding fiscal year from an income statement standpoint, and as of the most recent balance sheet date from a balance sheet standpoint. And really what this gets to is what does the combined company look like prospectively? So considering things such as cash paid as part of the transaction, stock issuances, private investment for additional seed funding, as well as adjustments to remove any debt or increase debt as part of the transaction. So a lot goes on here between SPAC management and operating company management, legal counsel, so a lot of different parties. So making sure everybody's on board and together for this entire process is an administrative burden in and of itself. So going through to the SEC review period, you'll notice here you've got about 75 to 90 days for an SEC review period. And you compare that against the SPAC IPO, which was about 6 weeks. And the reason for the extended review period was This is a much longer and intricate document, as well as you have operating company financial statements, non-GAAP measures, management's discussion and analysis, and some of the other areas we discussed previously, which are all required to be reviewed by the SEC. So as this process continues, SEC gives review comments, you process those comments, submit amendments, and similar to the SPAC IPO, if you cross over to a stale date, possibly updating your interim financial statements could be required. Now looking through to the very end, you've got a shareholder vote that Zach mentioned previously, excuse me, where really these initial SPAC investors have an opportunity to say, do I want to be a part of this company going forward? And if so, they leave their money in the operating company prospectively. If not, they actually have an opportunity to redeem their shares. And the interesting thing here is that redemption is actually a bit of a game. So these SPAC holders, where you have the units, are able to redeem the shares and also retain partial ownership through those warrants. So generally speaking, if an institutional investor has significant investment, they might redeem some of their shares and not redeem other shares, but other factors are considered, such as faith in the operating company, as well as current market conditions. Similar to what we saw for the SPAC IPO, management will be required to sign the 302 and 906 certifications, indicating that they have effective controls over financial reporting. And then 404A controls will not be required until the second filed 10K. So moving on to some of the other significant accounting impacts of the actual SPAC transaction itself is going to be identification of the accounting acquirer. So if we're looking at slide 14, without getting into, sorry, if we can just jump to 14. If we look through to who's the accounting acquirer, the SPAC is generally considered a shell company and therefore not a business. And if the SPAC acquires the operating company from both a legal and an accounting acquirer standpoint, that transaction will be considered a business combination. As such, the operating company would be required to get a full valuation, do a purchase price allocation, record goodwill, intangible assets, step up the basis of all the assets. And as part of that process, it can delay the intended filing timing and transaction timing if not prepared for. So understanding that on the inverse, if the operating company is identified as the accounting acquirer, that transaction will be considered a capital transaction, and therefore no step up in basis, no intangible assets or goodwill recorded. So we'll look through to what does that mean, identifying the accounting acquirer? And really what we're getting at here is identifying who controls the combined company prospectively, who has voting interests, who has majority of seats on the board, who runs the company from a key management standpoint, and who is who's the larger entity. So there are scenarios where the SPAC actually does become the accounting acquirer. While a little bit more rare, it can provide some significant delays. So I guess the key takeaway here is understanding that the structuring of your business combination agreement will dictate your accounting acquirer. So moving on to a couple of concessions that are offered by the SEC through the Jobs and FAST Acts. A little bit of a busy slide here, but I think the key points to note here are some concessions related to historical periods. If you qualify as an emerging growth company, effectively a smaller company under $1 billion worth of revenue, less than $1 billion of finance debt, etc., you're able to actually knock off the third year of comparative P&L cash flows and statement of equity, as well as, and this is key for a lot of private companies becoming public, is you're actually able to adopt accounting standard pronouncements under private company deadlines. And that can be significant for heavy lifts such as 842 or CECL that private companies haven't necessarily thought all the way through. You're able to actually adopt those under private company standards. So a couple of other concessions on the Jobs and Facts Act here. Assuming that you've had an accounting acquisition over the past couple of years, depending on the significance of that acquisition, you may be required to file standalone financial statements. And if you qualify as an EGC, there is a third period that you would, again, be able to knock off consistent with that of the parent financials. And then lastly, I want to point you to SOX 404B. Generally speaking, if you are not qualified as an emerging growth company, you'll be required to have your auditors opine on your internal control environment. If you qualify for this emerging growth company requirement, you actually are able to defer that for up to 5 years, depending on your status. But however, if you toe the line, makes sense to go ahead and start drafting that up and making sure that you've got controls that are able to be signed off on by your auditors. So with that, I think we've walked through the process, pretty exciting stuff. I'll turn it over to my colleague, Ryan Gamble, who is going to talk you through some of the tax considerations and implications and try to make tax sound fun. Ryan?
Thank you, Josh. I'll certainly do my best, and welcome everyone. In addition to the benefits and advantages that Josh and Zach have highlighted in the previous slides, a SPAC also provides certain tax benefits and advantages over a traditional IPO when combined with what's called an Up-C structure. In a traditional IPO, where the operating company is structured as a flow-through entity depicted here as a partnership, the partnership converts to a C corporation and offers corporate stock to the public in an IPO. From a tax perspective, the conversion results in two outcomes that are both disadvantageous to the founding partners. First, as a result of the conversion, the partnership loses its status as a flow-through entity, and therefore the partners are no longer afforded one level of tax, but rather now pay at two levels, one at the corporate level, and again at the individual level when distributions are paid from the corporate entity. Secondly, in the conversion, the inside basis of the assets carry over to the corporate entity, and they're at their current value, and in other words, no step up, and therefore no additional depreciation or amortization deductions. However, in an Up-C context, the transaction is treated as an acquisition and not a conversion, as depicted on the next slide. The SPAC acquires a certain percentage of partnership interest from the founding partners, resulting in a number of tax advantages to the founding partners and to the SPAC. First, in an Up-C structure, the partnership serves as the operating entity, as opposed to the corporation in the traditional IPO setting. As a result, the founding partners receive or preserve their single level of tax. Second, the acquisition results in a step up of the inside basis of the assets of the partnership, and therefore the public company receives additional depreciation and amortization deductions. In an additional benefit to the legacy owners, in a typical Up-C structure, the public company and the founding partners enter into what's called a tax receivable agreement, under which the public company pays the legacy owners a percentage of the tax benefits, usually 85%, associated with that additional tax depreciation and amortization realized from the step up. So not only do the founding partners receive compensation for their partnership interest, but they also receive compensation of the tax benefits associated with the sale while maintaining the tax advantage status in the partnership solution. Finally, each payment under the TRA is treated as additional purchase consideration, thereby resulting in additional depreciation and amortization, and as a result, additional future payments under the TRA to the founding partners. So in summary, a SPAC combined with an Up-C structure can turn the tax disadvantages of a traditional IPO structure into advantages, with the additional benefit of payments to the legacy partners for the tax benefits realized from the step up. And with that, I believe we've reached our second polling question, and I'll turn it back over to Michael.
Correct. Thank you, Ryan. Thank you, Josh, Zach. Our second polling question is, have there been recent SEC financial reporting updates to facilitate more efficient access to the capital markets? A, yes. B, no. C, uncertain. D, what does college football have to do with it? Zach, while we're waiting for the results to come in and folks to answer the question, what are you seeing? And I know we'll dive in, but a little bit more. What are some of the benefits to what the SEC's put out recently for companies?
Yeah, for sure. It is definitely an exciting time to be alive, right? Not only because of the topics we've discussed here on, the uptick of SPAC activity, but also, we're seeing the SEC become a little bit more gentler and friendlier with respect to the financial reporting requirements that go into really all registration statements, in particular S4s and 14A proxies in a SPAC deal. We'll go through some of the specifics, but the general theme is, over the last couple months, there's been unprecedented changes in my career and probably decades with respect to giving companies a little bit of a shortcut in complying with very old SEC financial reporting regulations. So.
Thanks, Zach. So yes, there has been certain revisions to the SEC financial reporting guidelines, and Zach, now you'll get into that a bit more in detail. So we'll look to you to take that off.
Yep. So we go to the summary here of SX. It's called Rule 2020-118. So in May this year, so right during the COVID period, the SEC came out with non-COVID. They were planning on this issue for years. Relief, right, with respect to very commonly 305 and Article 11, some other stuff in that space. The adoption date is January 1 of 21. Early adoption is permitted, and for some of the clients that we're assisting on these types of transactions, early adoption is actually very encouraged and advantageous for some reasons we'll get into in a second. But just know that it's applicable Jan 1, early adoption permitted. There are some specific industry changes on 314 and 611 for real estate and other industries that we're not going to get into in super detail in the webinar here, but check out some of the thought leadership that we'll flash up at the last slide here and let us know if you're in that space, because there's some interesting changes to the financial reporting aspects and requirements in those industries. But ultimately it's the SEC, facilitating faster access to the capital markets for many companies. So if we head to the next one here, so the significance test, right? The significance test is a tool in which the SEC uses to help companies determine if a recent or upcoming acquisition is significant enough for an investor to see standalone financial statements of that target company and a registration statement. So many folks on the phone are familiar with this. I won't go into the legacy old school rules here, but what we will highlight is a couple of key changes. One is the income test, which for folks on the phone that practice this stuff regularly probably know and have experience that the income test is the one of the three that is usually the most common to trigger 305 reporting requirements, because many times you'll have an acquirer that may be or has recently been break even. So the denominator in the test, assuming to be close to zero, automatically triggers the well-known 20% threshold. So what the SEC did is they came in with a revenue component within that income test, to where an acquirer or registrant, if you will, gets to choose which of the two are more beneficial for them. So if you trigger the income test, but you don't trigger the revenue component within that, then you get to choose the more beneficial piece of the revenue and you pass that test. So pretty exciting stuff, never been around. Again, these rules are 20 to 30, maybe 40 years old. And it's pretty exciting that these rules have come out this year where we all get to participate in being the tip of the sword and applying these in most cases. So, and then the second one is this concept of a aggregated worldwide market value, AWMV, which is different than public float that we're all familiar with when testing our accelerated filer status every June 30th. But anyway, it's more relevant for an existing public company in as an alternative in the denominator in the investment test. Instead of using your own assets, you now can use this aggregated worldwide market value, and we'll see how folks apply that and define that as we go through this process. But the important point here is a little bit of relief most of the time for existing public companies, less so for a company going through, a private company going through a traditional IPO, but just be aware that technical change has been made. And then lastly, the asset test, which, for me, rarely results in a trigger of significance. But anyway, the point there is there's no change. So just to recap, the SEC is making strides to facilitate faster access to the capital markets in the significance test bucket. So if you go to the next one, how to apply it. So the traditional buckets are 20 to 40, and 40. So the old school over 50 bucket has basically gone away. We're now in a situation where the couple major things here. So in the 20 to 40% bucket, and again, assuming that the three tests we just talked about, you pick the highest or the worst case of all three. If you end up in the 20 to 40% bucket, you actually get relief on your comparative interim period. So say, for example, you're filing today and you have to do annual 19s, 6 months ended 6/30/2020 and 6 months ended 6/30/2019. In the scenario that we're showing here on the slide, if you're 20 to 40 under the new rules, you actually can eliminate and not spend the time of quarterizing your 19 year, at least for external financial reporting purposes. You may need to quarterize it for different purposes, but the SEC no longer would require you to file a registration statement with comparative interim period. So pretty exciting chop off there on that comparative year, comparative interim period. And on the over 40 bucket, you're capped at 2 if you are over 50, right? The old school stuff. If you were non-AGC, you'd have to have 3. But now you're capped at 2. SPACs have an interesting practical application there that based on when the SPAC files its first 10K. But just be aware that the SEC is now limiting that potential situation where you could have 3 to 2, but you don't get relief on that comparative interim, unfortunately, in that 40% bucket. So, and just to highlight here, these rules are not applicable to a company filing a registration statement with a legally probable acquisition that's over 50. In that situation, you actually may not get most of this relief, but again, there's always practical exceptions to all rules. But anyway, if you're considering marketing your SPAC deal with an upcoming probable acquisition, you may have actually the same onerous financial reporting obligations that you did under the old rules. And last but not least, pro formas. Look, we all love talking about pro formas, as they seem to always be the more meaningful set of financial statements and a registration statement in a S4 proxy in this case, above and beyond the historical audited financial statements. So anyway, the key thing here is the SEC has made very unprecedented changes on 2 things. One is the form in which the pro formas look and feel, right? Now we have these 3 buckets called transaction accounting adjustments, autonomous entity adjustments, and then thirdly, the optional management adjustments. So just be aware of that. While the spirit of pro forma rules from back in the day around factually supportable and directly attributable to the acquisition are still the spirit of Article 11, the way in which they're presented and shown to the investor and the reader of the financial statements is gonna look different. And then lastly, and the most interesting point is the SEC is now allowing folks to include synergies into a set of pro formas. So think revenue synergies in a combination or G&A synergies in a combination. For SPAC mergers, there could be some G&A synergies that management may choose to present. It will be interesting to see how in practice, our clients adopt this from a risk management standpoint. There's obvious concerns around putting forecasted cost savings into a set of historical financial pro formas in a public filing. So far, our clients have elected not to adopt this optional presentation. But as we, again, are the tip of the sword here with adoption of January 1 coming up, it'll be interesting to see if our clients and others do take advantage of that helpful optional presentation in these new sets of pro formas. So Michael, I guess with that one, we'll go to polling question 3, I believe.
Yep, polling question 3. Thank you, Zach. Appreciate that. Polling question number 3. My organization is focused on financial close optimization efforts to prepare for the public company reporting calendar. Yes, no, uncertain. There is a calendar. So let us know where you are. While they're doing that, Greg, can you talk a bit about some of the highlights that you're seeing or points of struggle for companies transitioning to that public company calendar?
Yeah, thank you, Michael. Certainly. In our point of view, and I'll get into more detail on this, it's not just about achieving compliance. The ones that will really create a differentiating advantage through something like this is those who can achieve compliance in a efficient and effective way through process elements and technology elements. But we'll talk about that in more detail.
Good. Okay. So there are the results. Kind of a mix. People in different stages preparing. So, okay. Well, thanks, Greg. Yeah. Now maybe you can give us, like you said, a little more color on those topics.
Yeah, certainly. So at this point, we're going to shift gears a bit away from the technical accounting topics and talk more about the operational considerations and what your organization needs to be thinking about to operate in a more sustainable way as a public company. So shifting to the next slide, the point I want to start with is that a SPAC is much bigger than just a capital markets and accounting event. Obviously, there are significant technical accounting, controls, legal, compliance requirements that you need to be considering. But you also need to be thinking outside of the controllership organization, recognizing the broader finance, legal, and HR impacts of being a public company. And to dig into this a little bit more, within the finance column here, you will be required to articulate financial plans and guidance to external stakeholders, which will require investment and capability in the FP&A realm. This may be different than how you're operating today. You may not have done this too much in the past, but this will certainly be something that you will have to consider. And then alongside not just doing it, but how efficiently do you do it? So what technologies will you use? What will your process look like? And related from an investor relations perspective, you now have another external stakeholder group that you're going to have to manage and communicate to through the channel of investor relations. So what sort of processes and reporting and cadence do you need to establish to most effectively communicate and manage your third-party investors? And then moving across from a legal and tax perspective, we spoke quite a bit about that, so I won't go back into that. But if we're thinking about HR, being a public company brings another tool to your benefits program and incremental compensation options like equity grants. And along with that, there are compliance and process considerations to how that will get managed and monitored and communicated to your employee base. So again, not just an accounting event, certainly cross-functional. And our suggestion is that as you think about these cross-functional changes, you'll need to put a little bit of structure around it in terms of how you manage the change, how you communicate to the organization, and how you execute it in a coordinated way from a project management perspective. So continuing on, I want to share a bit more of the operational challenges that we see companies typically face as they go through something like this, whether it's a SPAC or a traditional IPO. And I'll speak about the first two here together because they are often related. So lack of speed in terms of closing the books and reporting externally, and then the manual nature of processes are often the two biggest operational challenges that we see companies face when considering something like this. Because it obviously is new. There is a calendar, as some are aware of, and that calendar needs to obviously be adhered to. And then if I think about lack of speed and manual processes, there are typically a couple of root causes related to these. One, which is probably the most prevalent, is the lack of investment in technology. Particularly to automate transactional accounting activities. So how do you move from operating in a manual fashion to operating in a more automated and efficient fashion? And we're seeing, for companies that go through this, we see them investing in technology to really overcome some of these common challenges. Another root cause is heavy reliance on Excel spreadsheets. I'm sure no one operates in that environment, and that is related to the first one around technology. But where is Excel appropriate, and where do you need to high grade from a technology perspective? And then moving down the list, in terms of insufficient accuracy and control, if you're in the situation where you're often having to make adjustments or corrections after the books are closed, or if you spend a lot of time reconciling between external reporting packages, if you have them today, and internal management reporting, that is often a signal of a breakdown somewhere in the process that needs to be addressed. And that's an underlying fundamental that will help avoid a situation around a control deficiency or a material weakness that obviously you don't want to get into as a public company. And then the last one that I'll touch on in terms of challenges is around analysis and decision support. This is related to the FP&A topic that I touched on the previous slide, but this is an area that gets much more attention as you enter the public domain. And the key here is obviously being able to efficiently aggregate data and efficiently generate reporting so that you can spend more time on the analysis and more time on the business drivers and the story around the business performance, as opposed to having all your effort being spent on aggregation and reporting, which often puts analysis in the back seat. So to complement the challenges we just talked about, let me touch on some leading practices that we see in the marketplace as it relates to the overall closed cycle. And we often break this cycle down into two parts. So the first part being subledger close to consolidation, and then the second part being management reporting to SEC filing. On the slide in front of you is focusing on the first part. So from subledger close to consolidations, some targets that we see out there for you to consider in terms of milestones. A leading practice that we see is subledger close typically complete by workday 3, and then consolidation and management reporting, internal management reporting, complete by workday 7. And on the right-hand side are some common enablers that we see these leading practice companies deploy and use to help reach those milestones. As you can read on the slide, a lot of these are technology focused. A lot of them rely upon making sure that there is standard data structures, and also making sure that there's good governance and accountabilities over the close process. And then moving on to the second part of the close the report process and leading practices, in terms of moving from internal management reporting all the way through SEC filing. Some leading practice milestones we see is that disclosures and MD&A complete by Workday 15, and then SEC filing by Workday 28 for Qs. And then again, some common enablers on the side. In this part of the process, it is largely report generation, analysis. You're obviously done with journal entries and other transactional subledger type things. So this is where we also see a lot of technology utilized, but different types of technology. So this is where your dashboarding and your visualization tools come into play. This is where your reporting tools come into play, and those really help. Having those in place really help companies achieve these sort of milestones. So to bring it home, before I hand it back to Michael for the final polling question, I want to leave you with how we view this in terms of a holistic approach. And it will take, I believe, holistic approach for companies to create those sustainable operations and that differentiated advantage that I mentioned earlier in terms of efficient and effective operations around this sort of an event. So four dimensions for you to consider. The first is organization structure. How do you organize your finance and accounting function to best meet stakeholder needs? Often what we see is the creation of a center of excellence where you have not only your technical accounting capability, but also your FP&A capability within a center of excellence. From a people perspective, this sort of event certainly requires a different capability of your people. So I encourage you to think about how you invest in and support your teams with developing those requisite capabilities. And then the last two we've touched on quite a bit. So process and then technology. How do you create streamlined and standard processes that are repeatable month over month, quarter over quarter? And then where do you strategically deploy technology to really make this process work for you as opposed to you working for it? So in closing, these are the dimensions that you need to be looking at. And certainly happy to dig into each of these with you outside of the webcast. So with that being said, Michael, back to you for our final polling question.
Thanks, Greg. Thanks for bringing in some of the operational aspects of the SPACs and capital markets transactions. So now that you know more about SPACs, the process and the benefits of SPACs, what are your concerns, if any? A, SEC financial reporting. B, financial close inefficiencies. C, tax matters. D, no concerns. You've got it. While we wait for that, we've got one polling question, or one question that's come in. So I just want to give that a minute. And Zach, maybe you can speak to this. When someone's first going down this path, the SPAC path, what are the important first steps that they should consider?
Yeah, that's an interesting one, and one that we get pretty often. And while we're waiting on the polling question, a couple lessons learned, good and bad through helping clients do these types of transactions is one, getting competent SEC counsel. Company counsel will drive a lot of these processes, and make sure folks are doing what they need to do in the timeline they need to do it. One, to get the S4, the proxy put together, but then two, how do we get from that point of the first filing to the merger effectiveness date? So getting competent SEC counsel, obviously we work with a lot of the firms, so definitely have great friends in that space. You know, two would be make sure auditor is PCAOB independent. That's a huge time drag that is a bit of a surprise for some of our clients. And then lastly, you know, mapping out your, you know, I guess your financial reporting requirements, anything strange, right? 305s, or if you're going to market the deal on acquisitions rather than organic growth, you may trip up 305s, which causes a month or two of delay, right? So, you know, like everything, getting the right team around you and project planning is most of the pain at the beginning, right? And at the end, what Greg was talking about, you know, you're going to have a ton of advisors helping you to get on file and get the deal closed, and then you're left with raising the baby, right? And closing your books in 15 days to do your press release by workday 25 is part where you're kind of on your own, right? So making sure you have folks around you that can help you get there is something that probably should start sooner rather than later.
Thanks, Zach. I think there's one more if we can sneak it in here. We've got a couple of minutes. So the question is, how is a direct public offering different than a SPAC?
That's interesting. Yeah. So we actually do have a thought leadership piece on that one. A DPO is actually a much different vehicle, non-capital raise. You as a legacy investor get to flip your units on the public market with obviously a legal hold period, I believe. But it's a new vehicle, probably not as popular as SPACs yet. We'll see, depending how the next 6 months shake out. But it is another alternative to accessing capital and getting your legacy investors monetized out in a different way. So.
Okay. Thank you. Well, I guess in closing, you know, thank you for participating and joining us today. We try and make these sessions practical, and all of our resources are available to you at our website, riveron.com. So you can register for upcoming webinars. We'll touch on things like capital markets, audit readiness, any technical emerging accounting issues. So look for those coming up. We do these once a month, sometimes twice a month. So they're fairly regular. Please reach out with any questions you have, and contact one of the presenters if you'd like the SPAC playbook. We're happy to share that with you. So look for the email coming up. Let us know if you have any questions, and have a great rest of your day and week. Thank you, and be well.